all of our growth, new data suggests home prices are slowly dropping after the record highs we saw just last year.
I'm a buyer in Austin, Texas. Now's the time to buy. I mean, our prices are down compared to the last 24 months.
No one saw this coming. Texas, the unstoppable housing giant, just hit its highest listings in 14 years. Prices are slipping, sellers are panicking, and economists say it's happening faster than 2008. The boom state turned bust almost overnight. If Texas cracks, what happens to everyone else? Stay tuned. What just happened here could rewrite America's housing story. What's happening? Right now, economists are sounding the alarm. Active listings just hit 141,950 homes in 2025. That is the highest level in 14 years, according to the Texas Real Estate Research Center at Texas A&M University. Inventory is climbing faster than it did during the 2008 housing crash. Yes, you heard that right. Faster than the Great Financial Crisis. The Lone Star State was supposed to be unstoppable. Low taxes, booming migration, endless sunshine. But today, we are going to walk through exactly what just happened, why top economists are genuinely concerned, and what this means for anyone who owns property, wants to buy, or is watching their equity evaporate. The setup nobody saw coming. To understand what is happening right now, you need to know where Texas came from. Just 3 years ago, this state was the hottest housing market in America. During the pandemic, Texas became the promised land for Americans fleeing high-cost states like California and New York. In 2022 alone, net domestic migration brought 222,100 new residents into Texas, according to Reventure App CEO Nick Gurley. People move for affordability. They move for jobs. They move because a house in Austin or Dallas cost half what it did in San Francisco. Texas responded by building homes at a pace no other state could match. In 2024, Texas issued 15% of all new home permits in the entire country. 15%. One state. The construction industry was white hot. But here is what nobody predicted. That wave of migration just stopped. By 2024, net domestic migration collapsed to 85,200 people. That is a 62% decline in just 2 years. The math is simple and brutal. Texas built for 200,000 new arrivals per year. Instead, it got less than half that number. Now those homes are sitting empty, listed, and waiting for buyers who are not coming. Chen Zhao, an economist at Redfin, told Newsweek something critical. She said buyers in weaker Sunbelt markets like Florida and Texas may be able to negotiate the best deals this year. Translation: Texas went from a seller's paradise to a buyer's market in less than 24 months. The shift happened so fast that builders, investors, and homeowners are still reeling. Mortgage rates hovering between 6.75% and 7% made things worse. Affordability vanished. Buyers disappeared. The Texas Real Estate Research Center reports that entry-level homes, those priced below $300,000, are experiencing the fastest inventory growth. These are the homes first-time buyers need. But high mortgage rates have locked them out completely. Those homes now sit on the market an average of 1 week longer than higher-priced properties. 1 week might not sound like much, but in real estate, that is a flashing red signal. Demand is cracking at the foundation. If Texas, the housing powerhouse, can stumble this hard, imagine what happens next in your city. Hit subscribe so you don't miss the next chapter. We track every sign before it hits the headlines. Inventory explosion, the numbers that shocked analysts. As of April 2025, Texas recorded 141,950 active home listings. That number represents a 31.4% surge compared to 1 year earlier. It is also 8% higher than just 1 month prior. The Texas Real Estate Research Center calls this the most significant supply buildup since 2011, when foreclosures were flooding the market during the housing recession. Here's the scary part. Compared to pre-pandemic levels in April 2019, active listings are now 41% higher. 41%. This is not a small correction. This is a structural shift in supply and demand that has economists genuinely worried. Nick Gurley posted on X, formerly Twitter, that listings hit 123,000 in April and are now 53% higher than normal. He warned that Texas is now the fourth most oversupplied housing market in the United States. Not 10th, not 20th, fourth in the entire country. He also noted that prices are now dropping across the state, not just in isolated pockets. But here is the kicker. New listings keep accelerating. In March alone, new listings surged by 16.2% year over year. In January, they jumped 17.1%. In April, more than 60,000 new listings entered the market, up 15% from a year earlier. Sellers are panicking. They are trying to get out before prices fall further. But this flood of supply is creating a feedback loop. More listings mean more competition. More competition means lower prices. Lower prices mean more sellers panic. And the cycle repeats. Marco Santarelli, founder of Norada Real Estate Investments, said in a February report that the Texas housing market currently presents a mixed picture. While the third quarter ended on a positive note, other indicators are showing a slowdown after the superheated market of the past few years. His firm is forecasting home price declines in 31 metropolitan areas across Texas throughout 2025. 31. That is not a correction. That is a repricing event. The Federal Reserve Bank of Dallas noted in their quarterly report that inventory growth is nearly double the buildup during the Great Financial Crisis. Let that sink in. The current pace of inventory accumulation is twice as fast as when foreclosures were flooding the market in 2008. Except this time, there are no mass foreclosures. This is simply too much supply chasing too little demand. Price cuts accelerate, sellers in full retreat. When inventory explodes, sellers have two choices: wait it out or cut prices. Right now, they are cutting prices. According to the Texas Real Estate Research Center, price cuts in the first quarter of 2025 accelerated compared to 2023 and 2024, reaching their highest level since 2011. That was the year foreclosures dominated the market. Price reductions are now a standard part of the listing process across Texas. Realtor.com data shows that in June, the number of homes with reduced listing prices jumped by 26% from a year ago. It is now the highest level in their decade-long data set. Compared to June 2019, price cuts are up 49%, nearly half. Sellers are slashing prices just to get buyers through the door. In May 2025, 65.7% of closed sales in Texas included price cuts of $5,000 or more, with a median reduction of $11,500. Think about that. 2 out of every 3 homes sold required a price cut. This is not a normal market. This is a distressed market where sellers are competing desperately for a shrinking pool of qualified buyers. The Texas Real Estate Research Center Home Price Index shows home price growth has stalled under mounting supply pressure. In April, the year-over-year home price change marked the weakest gain since August 2023. Among Texas' Big Four metros, home prices declined year over year in Austin, down 2.1%, Dallas, down 0.4%, and San Antonio, down 1%. Only Houston continued to post moderate annual gains at 1.6%. Here is what makes this terrifying for sellers. Austin has experienced 31 consecutive months of year-over-year home price declines dating back to November 2022. 31 months. That is not a blip. That is a trend, and it is spreading. Nick Gurley predicts that Texas home prices could drop an additional 4% statewide over the next year. But he added a chilling caveat. If there is a recession in the oil industry, he could see a 15 to 20% correction. Oil prices recently dropped to $57 per barrel, a level that is problematic for Texas's economy. Many local operators shut down production when oil gets that cheap, which has a knock-on effect on local employment and home prices, especially in markets like Houston and San Antonio. The median sale price in Texas dropped from $345,000 a year ago to $340,000 in May 2025. Nationally, prices rose. In Texas, they fell. That divergence tells you everything you need to know. Days on market explode. The velocity crisis. Real estate professionals know that days on market is one of the most important indicators of market health. Right now, homes in Texas are sitting longer than they have in years. The median days on market in Texas reached 32 days in May 2025, an increase of 23.1% from 26 days a year earlier. May and June traditionally record the shortest days on market because they are peak buying season. Yet even during the busiest time of year, homes are taking longer to sell. In San Antonio, the average time to sale hit 83 days, making it the slowest market in the entire United States, according to data from VIP Real Estate. Closed sales in San Antonio dropped 10.3% year over year. Buyers are simply not pulling the trigger. They sense prices are falling, so they wait. And while they wait, inventory piles up. In Austin, April 2025 recorded just 2,187 closed transactions across the metro area. That is a 15.6% drop from March and a 27.1% drop compared to April 2024. This kind of volume contraction during what should be the busiest part of the year reinforces that the market has cooled substantially. But here is the truly scary metric. In Austin, the new listing to pending ratio dropped to just 0.53 in the final week of April. A healthy market typically has a ratio near 1.0, meaning one pending sale for every new listing. But in Austin, for every 2 new listings, barely one is going pending. That is a stark sign that demand is cooling rapidly and listings are accumulating on the market. The activity index in Austin, another leading indicator, dropped to just 23.9%. It reflects a noticeable decline in the rate at which homes are going under contract relative to total listings. That number had been hovering in the 30s earlier in the year. The consistent downward trend points to one conclusion: more homes, fewer buyers, and longer selling timelines. Housing Wire reported that in Dallas, the pace of sales growth began to fall in the winter and has since turned negative. Despite the growth in new listings spiking and inventory still rising by 40% or more year over year. In Houston, home sales picked up in the fall, but have since stopped growing while new listings are up by 16.8% year over year. The Federal Reserve Bank of Dallas noted in their July Beige Book that housing market activity weakened during the reporting period. Foot traffic and sales continued to fall, and inventories were rising quickly. With softer demand, builders are increasingly relying on marketing and incentives, including discounting to close deals. Lot supplies rising and starts have slowed. Outlooks were pessimistic amid weak demand and elevated economic uncertainty. Affordability collapse, locked out buyers. None of this would matter if buyers could afford to step in and absorb the supply, but they cannot. Affordability in Texas has collapsed. Mortgage rates have remained stubbornly high, hovering between 6.75% and 7% throughout the first half of 2025. The Federal Reserve held interest rates steady at 4.25% to 4.5%, meaning mortgage rates will remain elevated through spring and likely beyond. This offers no relief from high borrowing costs while further limiting affordability and dampening demand. In Houston, households can now afford 9.4% fewer homes than before, due to mortgage rate increases and rising home prices over the past few years. Even though prices are now falling, the damage is done. Buyers who were priced out when rates were low are still priced out now that rates are high, even with lower home prices. The typical monthly mortgage payment in Texas has increased dramatically over the past 3 years. When you factor in rising homeowner insurance costs and property taxes, which are climbing across the states, the total cost of home ownership has become prohibitive for middle-class families. Texas Realtors Chairman Christy Gessler said that buyers had more opportunities and a little more breathing room in the first months of this year compared to last year, but prices and sales did not shift much in either direction in most Texas markets. Entry-level buyers, the lifeblood of any housing market, have been disproportionately impacted. The Texas Real Estate Research Center reports that entry-level homes priced below $300,000 are leading the surge in inventory growth. High mortgage rates have locked out first-time and moderate-income home buyers who often have limited savings and rely heavily on financing. Over the 4 months ending in April, these lower-priced homes have remained on the market an average of 1 week longer than their higher-priced counterparts, underscoring sharply weakened demand. Nick Gurley warned that so long as Texas remains this unaffordable for local buyers, its housing market will struggle. The problem is not just high prices. It is high prices combined with high rates, combined with rising insurance costs, combined with elevated property taxes. It is a perfect storm of unaffordability. The Federal Reserve is caught in a bind. If they cut rates, they risk reigniting inflation. If they keep rates high, they continue to choke off housing demand. Either way, Texas is stuck. The oil wildcard. Texas's Achilles heel. Here is something most people outside of Texas do not fully appreciate. This state's economy is still deeply tied to oil and gas, and oil prices just collapsed. In September 2025, the Federal Reserve Bank of Dallas held its quarterly energy survey. Officials reported a slight decline in the upstream oil and gas sector on a quarter-to-quarter basis. The survey said negativity among firms and rising costs are leading to overall uncertainty. Kunal Patel, senior business economist for the Federal Reserve Bank of Dallas, said that as a whole, oil production employees are working almost 4 hours less per week. When asked what price is needed to profitably drill a new well, the average response was $65 per barrel, with smaller producers indicating a need of $66. Oil prices recently dropped to $57 per barrel. That is below the threshold for profitability. Many local operators shut down production when oil gets that cheap. This has a direct knock-on effect on local employment and home prices, especially in markets like Houston and San Antonio that are heavily tied to the energy sector. Nick Gurley said he could see a 15 to 20% correction in Texas home prices if there is a recession in the oil industry. That is not a small risk. That is an existential threat to home values across the state. The Federal Reserve Bank of Dallas noted in their July report that mining and logging losses are now showing a persistent decline, likely due to declining oil prices. Energy contacts told the Fed they are reconsidering planned layoffs after the run-up in oil prices. But those gains were temporary. Contacts expect to cut capital spending in the second half of the year by more than initially planned, as oil prices will likely stay low on account of rising overseas production. Energy companies also reported elevated uncertainty. The Texas economy showed signs of a recent dip in economic activity in June 2025, possibly reflecting the impact of the trade war and lower oil prices. Several Texas metropolitan areas, including each of the large metropolitan areas, showed a decline in employment. Each of the goods-producing industries experienced losses, with mining and logging experiencing the largest losses. If oil stays low, the housing correction gets worse, much worse. So, what does all of this mean? Buyers currently hold the upper hand in Texas real estate. Inventory is high, sellers are slashing prices, and days on market continue to climb. If you're financially ready and patient, this is your best opportunity in years. Sellers, on the other hand, must face reality. Price your home correctly from the start or risk sitting on the market while competition increases. This downturn isn't seasonal, it's structural. Investors should proceed with caution. Cash flow matters more than appreciation. With low oil prices and persistent mortgage rates, this correction could linger another year or more. Renters may finally get relief as unsold homes convert to rentals, boosting supply and softening rents. For the Texas economy, the slowdown is a warning. Housing fuels construction, retail, and finance. And when it cools, the ripple effects spread fast. The Dallas Fed reports growing uncertainty across sectors. Texas isn't alone. Florida and other Sunbelt states show similar cracks. Built for endless growth that stalled, Texas now faces the consequences. The question isn't if the correction happens, but how deep it cuts and how long it lasts. Subscribe now for more real estate insights like this.